So would you like a deeper dive understanding the difference between a conventional loan and an FHA loan? Let's take a look. So typically there are many factors that are going to determine what loan product is going to be best for someone, but I'll say some of the biggest driving factors I'm going to cover in a quick video because, I could literally talk all day about this because I'm a dork like that. So one of the biggest things is going to be, let's talk about a few of them: credit score, debt to income ratio, and assets and reserves, money in the bank. So cash, credit, and income. Those three things are going to be the biggest driving factors. Property may have a little bit to do with it as well. For example, you're wanting a property that may not meet the FHA minimum property condition. But let's talk through that real quick. Usually what I see is if a credit score is under a 720, the FHA loan is going to be better. They have lower interest rates. The mortgage insurance is lower also. If you're wanting to do a conventional loan and you have under a 720 credit score, usually you're going to get hit with what's called risk-based pricing, or lenders call them LLPAs, loan level pricing adjustments. Okay. That is additional risk that lenders have to take. They've done all the analysis and looked at the foreclosures and the delinquency rate, and they say, hey, anybody under a 720 credit score is a little bit of additional risk, so we're gonna tax you. Like, I'm paraphrasing this. Of course, they're not going to come out and say that, but that's what's happening. Okay, and just know also it's tiered in increments of 20 points. So, for example, 720 to a 700 is going to have one interest rate. 700 to a 680 is going to have a higher interest rate. 680 to a 660 is going to have a higher interest rate. 660 to a 640 is going to have a higher rate. Under 640, you become a big risk. They've determined that over the years of a lot of research and these fancy analysts, and they've determined that you're really high risk. We can still get you a loan. Just know you're going to have to pay for it. Your interest rate's going to be a little bit higher. You'll probably also have to pay a point or so to get the loan, depending on your scenario. What's the point, you may ask? It's 1% of your loan amount. Call that a tax for having low credit. Okay. So the main thing, FHA loans do allow for higher debt to income ratio. So if I've got a client that just found a house that they absolutely love, and they want that house, but their debts are really high, well, even if they have good credit, more than likely I may have to put them in an FHA loan just because of their debt to income situation. Okay? Now, when would it be better to put someone into a conventional loan? An example of that could be a conventional loan is going to be good for a self-employed borrower. Let's say COVID happened in 2021, they had low income, but 2022, they had better income, and I only want to use 1 year of tax returns because by averaging the 2 years, FHA requires 2 years of tax returns. Okay, keep that in mind for self-employed borrowers. But if I have to average in 2 years, that could bring their debt to income ratio really high, disqualifying them from the loan. But just know on a conventional loan, even though they have a lower credit score, you may have to take the hit and do a conventional loan and just take the hidden rate because I'm only using 1 year tax return. See how it gets complicated? There's multiple factors that are going to go into it. So credit, debt to income ratio, and then reserves in the bank. Let's talk through reserves real quick. So if they've got FHA loan is only 3.5% down. Conventional loans, typically 5%, depending on their income limit. If they are under the area's median income, they may qualify for a 3% down conventional loan, which is really cool. They don't have as much pricing adjustments on credit scores when it comes to lower income individuals or families. I hope that helps you guys, kind of some different factors. As a certified mortgage advisor, my job, my fiduciary responsibility is to make sure that we're putting everyone in the best situation possible. And I take that serious. My reputation, my company lies on that. And even if the deal doesn't make sense, or if you're not where you need to be, I'm going to shoot you straight. I'm going to tell you exactly where you need to be. And a lot of times I lose business because of that, because somebody will come to me wanting a conventional loan and I may say, hey, FHA loan is going to be a better deal for you, or vice versa. And they don't like that. And they go back to another lender because they're like, well, this is what I want. But if you trust me and listen to what I say, I will show you how one deal will make better sense for you over the long haul over the other. Sometimes you need to focus on the short term. Sometimes you need to focus on the long term. There's a time for each one of them, depending on your scenario. So glad to talk you through your scenario. Hopefully this was helpful.